If you are an investor who's interested in the India's growing consumption story and want exposure to mid and small cap companies in your investment portfolio, then especially the newly launched NFO Motilal Oswal Nifty Midsmall India Consumption Index Fund might have caught your eye. But is it really worth investing? Let us see if this fund could be a great addition to your investment portfolio or not through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Before analyzing this fund, let us first understand a few basic details about this fund. So as an NFO, it opens on 29th October 2024 and closes on 6th November 2024. And some of the key features of this fund are: it is an open-ended fund type which belongs to the category of equity, which is in the thematic theme of consumption theme, and it has Nifty Mid-Small India Consumption TRI as its benchmark index, and the exit load for this fund is 1% if you choose to redeem it within 15 days. And there is no entry load in this fund, and the minimum investment amount you need to start investing in this fund is just 500 rupees. And the fund managers for this fund are Mr. Rakesh Shetty and Mr. Swapnil P. Mayekar. And according to the riskometer, the risk involved in this fund is very high. Now, if you take a look at the investment objective of this fund, the primary investment objective of this fund is to provide investors with returns that before expenses closely correspond to the total returns of the securities as represented by the underlying index, which can be subjected to tracking error as this is an index fund. So now let's move on to understand the index it is representing. So if you take a look at the index it is representing, you can see that Nifty Mid-Small India Consumption Index tracks the performance of the mid-cap and small-cap stocks that broadly represent the consumption theme within the basic industries like pharmaceuticals, media and entertainment, telecom services, hotels, consumer electronics, residential and commercial projects, etc. So companies with domestic operating revenues for more than 50% are considered eligible to be part of the index. So this index includes up to 30 stocks which are selected from the parent Nifty index mid-small cap 400 index based on the stock's 6-month average free float market capitalization. So the weight of each stock in the index is based on stock's free float market capitalization, and this index can be used for a variety of purposes such as benchmarking fund portfolios, launching of index funds, ETFs and other structured products. Now let's take a look at the sectors it represents, which are healthcare sector, consumer durables, FMCG, realty, consumer services, power, textiles, media entertainment and publication. So the highest weight is given to the healthcare sector by a weightage of 22.82%, while the lowest weight is given to the media entertainment and publication sector by a weightage of 2.85%. Now let's take a look at the top 10 holdings in this index. So they are Max Healthcare Institute Limited, Indian Hotels Co Limited, Dixon Technologies India Limited, Colgate Palmolive India Limited, Voltas Limited, Marico Limited, Godrej Properties Limited, Phoenix Mills Limited, Fortis Healthcare Limited, Alchem Laboratories Limited. So the highest weightage and the first top position is given to the Max Healthcare Institute Limited by a weightage of 8.51%, while the top 10 position is given to the Alchem Laboratories Limited by a weightage of 3.68%. So now, according to the statistics, as you can see from the data derived, that the index returns as on September 30, 2024 is that in 1 year, this index has produced a return of 53.37 return, and in 5 years, it has produced a return of 28.39 return, and since inception, it has produced a return of 17.85%. As you can see from the data as well as the graph that it is representing, that in short term it might have many dips, but in long term it has consistently performed well. So now, as we have a basic understanding about this fund as well as the index it is representing, let's move on to analyzing the advantages and disadvantages of investing in this fund. So let's start with the pros. There are 4 main key advantages to investing in this fund. Number 1, exposure to the growing consumption theme. So this fund is focused on the India's consumption sector, which is expected to grow as income levels rise and consumer demand increases. So investing in this theme can be a great way to capitalize on the country's growing middle class. Number 2, mid and small cap growth potential. So by focusing on mid and small cap companies, the fund offers the potential for higher growth compared to large cap consumption companies. So these companies are often in the early stages of expansion, making them ripe for growth. Number 3, Diversification within the consumption sector. The fund offers exposure to a variety of industries within the consumption space such as retail, FMCG, auto, and consumer durables. This provides diversification across multiple segments, reducing risk from over-reliance on a single area. Number 4, and the main key advantages to investing in a fund like this, which is especially index fund, is the passive investment approach. So then in index fund, it follows a passive strategy, which means lower management cost, especially compared to an actively managed fund. So it is a cost-effective way to gain exposure to the consumption theme without worrying about high fees. So these are all the advantages you can get by investing in this fund. Now let's look at the cons. So there are 4 main potential drawbacks to investing in this fund. Number 1, sector-specific risk. So since the fund is focused on consumption, it is heavily reliant on the performance of this sector. If there is a slowdown in consumer spending or economic downturn, it could significantly impact the fund's performance. Number 2, higher volatility from mid and small cap stocks. So mid and small cap stocks tend to be more volatile compared to large cap companies. While they do offer higher growth potential to investors, they can also experience sharp fluctuations during market downturn. Number 3, limited flexibility with passive management. So being a passive fund, there is no active management to make adjustments here in this fund based on the market condition. So the fund simply tracks the index, which means it can't respond to specific risk or opportunities. So whether good or bad, it will only track the index. Number 4, one of the major potential drawback might be that it is not ideal for conservative investors. So you can't say this fund is suitable for every kind of investor. If you look at funds, it's not like every fund will be suitable to every kind of investor. Every kind of fund has its own unique investors. So like that, in this fund also, as you can see, due to its focus on mid and small cap companies and the consumption sector, this fund is better suited for aggressive investors who are willing to take on higher risk in exchange for potentially higher returns. So these are all some potential risks you might have to carefully consider before choosing to invest in this fund. So what is the final takeaway from our analysis? Is the Motilal Oswal Nifty Midsmall India Consumption Index Fund worth investing or not? As you can see, this fund offers great exposure to India's growing consumption story with the added growth potential of mid and small cap stocks. However, it comes with higher risk and volatility. So if you're willing to ride the ups and downs for long-term gain, then this could be the right fund for you. So as an investor, it completely boils down to what kind of investor you are and what kind of risk tolerance you have and what is the investment time horizon you have in your mind to achieve your own financial goals. So it all boils down to these factors, and it's completely up to you as an investor to decide whether investing in this will be suitable to you or not. But our personal opinion is that this fund might be suitable for an ultra conservative investor who's not willing to invest in actively managed funds. So even if you're someone who's not willing to invest in actively managed fund, then also we recommend that you invest in similar index funds that have a lower expense ratio and lower tracking error compared to this fund. Because if you do want to invest in an index fund, it's better to invest in a similar one which has a low expense ratio and lower tracking error, right? And also, if you do want your investments to beat the market itself, and you want dynamic fund management, the fund manager can take decisions based on the market crashes or based on how the market is performing at its peak, then it's better if you choose to invest in an actively managed fund if you have the risk appetite to take on higher risk, especially because actively managed funds have the potential to deliver higher returns than an index fund. And especially if you want your investments to beat the market itself, then it's better to go for actively managed fund, because good or bad, as you can see, index fund will only try to replicate the index and not beat the index itself. And finally, if you do not have the right kind of knowledge to select funds based on your risk tolerance and based on how to achieve your financial goals, and you want some kind of professional guidance because either you do not have the knowledge or you do not have the time to research about it because your life is already hectic, and make it more simplified and helpful for you, you can definitely consult with a professional financial planner who will look at the suitability of the fund you want to invest in based on the factors of investment objective, risk profile, overlap ratio, and allocation, and see if all these things align with your risk tolerance and with your investment portfolio to help you achieve your financial goals in a more faster and smarter way. So investing through a professional guidance from a certified financial planner will help you navigate your investment journey more simple and helpful for you in the long run. Definitely consider investing through a professional guidance as well. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.